As introduced, I'm Francis Whitbread from Edmund Carr. I'm a chartered accountant and chartered tax advisor. I've been a partner at Edmund Carr since 1991, seems a very long time. Chris has got the technicalities ready for me, but before I start, just a quick health check. Is there anybody here from HM Revenue and Customs? Sorry, I'll ask the question again. Is there anybody here who's prepared to identify themselves as being from HM Revenue and Customs? Well, hopefully I will say nothing derogatory about the tax authorities anyway, but just in case. Right, I'm going to run through a few income tax points quickly, then we'll get on to the, I suspect what a lot of you have come to hear about, the interest relief changes and some comments on that, and a few miscellaneous points to finish with. So, firstly, I'm sure those of you who've let properties fully furnished in the past are probably aware of this. Fully furnished, by the way, means the property can be occupied by the tenant when they move in. They don't need to provide anything themselves. What we used to have was the wear and tear allowance. You've got a 10% deduction of your rent less services to cover the cost of maintaining the furniture and fittings. That has now gone, and we're now on to what we call the renewals basis. So if the washing machine or the cooker breaks down and you replace it, you can claim a deduction for income tax purposes for the cost of that replacement. What you can't get a deduction for is if you buy a property that's partly empty and you fit it out yourself with the initial furniture. You cannot get a deduction for the cost of those items. That's what we call plant and machinery. It's part of the apparatus you're using to carry on your property letting business, but plant and machinery capital allowances are not available on a residential property unless you've got some very unusual circumstances. For example, I've got a client who's doing a residential let, and as part of the terms of that, he's got to keep the lawn mowed. It's an old farmhouse, there's a lot of grass, etc. there. The tenant isn't prepared to do it, so my client is. He's bought himself a rather nice lawn mower, and he said, can I get a deduction for that? And I think yes, he can, because it's not something actually in the house. It's part of the wider letting of the land as opposed to the building. Not on my slides, but a point that occurs to me on, again, if you've got a new property, you might go in and you think, we'll put a new bathroom in, we'll put a new kitchen in, because that way we can get a higher rent for it. Can you get a deduction for the cost of installing that new bathroom? Well, as always with a lot of these tax things, it depends. If the property, when you take it over, is capable of being let in its present state, in other words, you could get a tenant with the bathroom and the kitchen as it is, then if you subsequently replace them, you should be able to get a deduction for the cost of putting in, even if it is a slightly better bathroom. The revenue become a bit more flexible on replacing something with something that's slightly better. For example, if you replace timber framed windows with double glazing, which obviously is better, they will allow you a deduction for that. Very quick point, from April last year we've now got what we call the small property income allowance. So if you've got a very small letting income, if your turnover is less than £1,000, then you don't need to declare that income for tax purposes. If you're over £1,000, but your expenses are less than £1,000, you can claim a flat rate deduction of £1,000. It's working a bit like the way the rent-a-room allowance works. One allowance per taxpayer. If you're using your vehicle to travel round to inspect your portfolio of rental properties, you're now able to claim a deduction for mileage allowance, which is at the revenue's tax-free rate, which is 45p a mile for the first 10,000 miles and then 25p a mile thereafter. I suspect with everybody it's going to be the higher rate, because if you're doing more than 10,000 miles managing your portfolio, I'd probably be surprised. And of course it's got to be a business trip. Now if you've got a portfolio of properties, you've probably got a reasonable argument that you are managing them from your home address, therefore mileage travelling to your properties from your home probably will count. It's a business trip as opposed to a home to place of work trip. Just very quickly on the non-resident landlord scheme, if you're ever in the situation that you're perhaps sent abroad to work by your employer for an extended period, so you're away for at least one complete tax year and meet the conditions for being non-resident for UK tax purposes, you might decide to let out your property while you're away. Absolutely fine, but don't forget you've got to then enter the non-resident landlord scheme, which means you've got to register with the revenue, and your agent, hopefully I'm sure Martin and Co are, will also be registered, because the problem otherwise is the letting agent, or indeed the tenant, although I've never seen it happen in practice, is supposed to deduct basic rate tax from the rent that is being paid. And obviously you're going to have a lot of expenses that you will be able to offset, like interest, etc., repairs, so you'll end up paying too much tax and having to claim a repayment. Much better to get it paid gross in the first place, because in many cases the income will probably be covered by the personal allowance anyway.